In the corridors of international finance, where trillions of dollars move across borders in milliseconds, precious metals occupy a peculiar position. They exist simultaneously as ancient stores of value and modern instruments of speculation. Gold and silver have served humanity for millennia as monetary anchors, yet today they function within a complex ecosystem of derivatives, futures contracts, and algorithmic trading systems that would be unrecognizable to previous generations. Understanding how these markets truly operate requires looking beyond the surface-level mechanisms that most participants observe. It demands an examination of the structural forces that shape price discovery, the institutional dynamics that create asymmetries between different classes of market participants, and the geopolitical considerations that influence supply and demand patterns across continents. The modern precious metals market operates on multiple interconnected levels. At the most visible layer, individual investors and small institutions trade through regulated exchanges, purchasing physical bullion or financial products that track metal prices. Beneath this surface exists a far larger domain of institutional activity, where central banks, multinational corporations, and major financial institutions execute transactions that dwarf retail participation by orders of magnitude. The relationship between these layers creates inherent tensions. Information flows unevenly across this stratified landscape, with sophisticated players possessing access to data streams, analytical capabilities, and market intelligence that remain inaccessible to ordinary participants. This structural inequality has profound implications for how prices move and who benefits from volatility. Geographic considerations add another dimension of complexity to precious metals trading. While Western financial centers historically dominated price formation through institutions like the London Bullion Market and COMEX in New York, the past 2 decades have witnessed a significant eastward shift in influence. Asian exchanges, particularly those operating in mainland China, have emerged as critical nodes in the global network. The Shanghai Gold Exchange now handles physical volumes that rival or exceed Western counterparts, reflecting broader patterns of economic rebalancing between established powers and rising economies. This geographic diversification of trading activity creates opportunities for discrepancies between regional markets, particularly during periods when Western exchanges remain closed while Asian markets continue operating. The mechanics of price formation in commodities markets involve far more than simple supply and demand equilibriums. Derivative instruments, particularly futures contracts and options, allow market participants to take positions that are many times larger than the physical quantities of metal that actually change hands. This financialization of commodity markets means that paper claims on gold and silver vastly exceed available physical inventory. Under normal conditions, this system functions smoothly because most derivative positions are settled financially, rather than through physical delivery. However, this structure creates inherent fragility. If confidence in the system wavers, or if large numbers of contracts suddenly demand physical settlement, the mismatch between paper claims and actual metal availability could trigger significant disruptions. Leverage amplifies both opportunities and risks within this framework. Individual traders can control positions worth hundreds of thousands of dollars, while posting only a fraction of that amount as margin collateral. This leverage magnifies potential returns during favorable market movements, but it also creates vulnerability during adverse price swings. When markets move sharply in unexpected directions, margin requirements increase, forcing leverage participants to either deposit additional funds or liquidate positions at unfavorable prices. These forced liquidations can create cascading effects, where selling pressure from one group of over-leveraged traders triggers margin calls for others, producing downward spirals that feed on themselves independently of underlying fundamental factors. Market microstructure considerations become critical during periods of stress or transition. The opening of trading sessions represents a particularly sensitive moment, especially when markets have been closed for extended periods such as weekends or holidays. During these intervals, information continues to accumulate, while price discovery mechanisms remain inactive. When trading resumes, all of this pent-up information gets processed simultaneously, often producing rapid price movements as the market seeks a new equilibrium. These opening dynamics create opportunities for sophisticated participants who can position themselves advantageously ahead of these transitions, while potentially disadvantaging those who lack advanced preparation or who must react to price movements in real time. The concept of information asymmetry permeates every aspect of modern financial markets. Some participants possess superior analytical capabilities, faster data feeds, better connections to primary sources of market-moving information, or simply more experience in interpreting complex signals. In precious metals markets, this asymmetry manifests in multiple ways. Large institutional players may have insights into upcoming changes in industrial demand for silver, based on their relationships with manufacturing sectors. Central banks possess knowledge about their own buying or selling intentions long before those actions become publicly visible. Commercial miners and refiners understand supply dynamics through direct participation in production processes. All of these informational advantages create gaps between what different market participants know and when they know it. Volatility patterns in commodity markets exhibit characteristics that differ significantly from equity markets or currency trading. Precious metals can experience extended periods of relative stability, punctuated by sudden sharp movements, triggered by geopolitical events, monetary policy shifts, or technical factors within the market structure itself. These volatility clusters create challenges for risk management. Traditional approaches to position sizing and stop-loss placement may prove inadequate when markets gap significantly, meaning prices jump from one level to another without trading at intermediate points. In such scenario, protective orders designed to limit losses may execute at prices far worse than intended, potentially resulting in outcomes dramatically different from what participants anticipated. The role of institutional actors in shaping market dynamics deserves careful examination. Large banks, hedge funds, and proprietary trading firms operate with resources and capabilities that fundamentally differ from retail participants. They employ teams of quantitative analysts, maintain sophisticated technological infrastructure, and can execute complex multi-leg strategies simultaneously across different instruments and time zones. More significantly, the sheer size of their capital base allows them to influence price action through their trading activity. When a major institution decides to establish or unwind a large position, the market must absorb that order flow, potentially creating temporary price distortions that sophisticated players can anticipate and exploit. The intersection of physical and paper markets creates another layer of structural complexity. While most precious metals trading occurs through financial instruments that never involve actual metal changing hands, the underlying physical market provides an ultimate anchor for price discovery. However, the relationship between these domains is not straightforward. Transportation costs, storage considerations, insurance expenses, and logistical constraints mean that physical metal cannot instantaneously arbitrage away price differences between financial and physical markets. These frictions create opportunities for temporary divergences that may persist longer than purely financial theory would suggest. Regulatory frameworks governing precious metals markets vary significantly across jurisdictions, creating a patchwork of different rules, reporting requirements, and supervisory approaches. Some exchanges operate under rigorous oversight with extensive transparency requirements, while others function with considerably less scrutiny. This regulatory fragmentation creates opportunities for regulatory arbitrage, where sophisticated participants can structure their activities to take advantage of less restrictive jurisdictions or can shift positions between different regulatory regimes in response to changing conditions. For participants operating within a single regulatory framework, this global complexity may be difficult to observe or understand, yet it shapes market dynamics in meaningful ways. The psychology of market participants plays an often underappreciated role in price formation. Fear and greed, confidence and panic, create feedback loops that can amplify or dampen fundamental factors. In markets characterized by significant retail participation, such as precious metals, these psychological dynamics can become particularly pronounced. Narratives about monetary debasement, geopolitical instability, or economic collapse can drive buying waves that push prices well above levels justified by industrial demand alone. Conversely, losses of confidence can trigger selling cascades that temporarily depress prices below fundamental support levels. Understanding these psychological patterns and how they interact with structural market features provides crucial context for interpreting price action. Risk management in volatile markets requires sophisticated understanding of not just probable outcomes, but also tail risks, those low probability but high impact scenarios that can devastate unprepared participants. Traditional approaches based on historical volatility patterns may severely underestimate the potential for extreme movements. Position sizing becomes critical, with careful consideration of worst-case scenarios rather than expected outcomes. The use of leverage must account for the possibility of markets moving far beyond normal ranges, particularly during periods when liquidity evaporates and price discovery becomes erratic. Defensive strategies, including the strategic use of options or the maintenance of significant cash reserves, can provide insurance against catastrophic scenarios, even though they reduce potential returns during normal conditions. The temporal dimension of market structure creates additional considerations. Markets operate in cycles at multiple timescales simultaneously. Intraday patterns reflect the opening and closing of different global trading sessions. Weekly cycles emerge from the rhythm of business activity and the closing of markets during weekends. Seasonal patterns appear in some commodities based on industrial usage cycles or historical trading conventions. Beyond these shorter rhythms, longer-term cycles spanning years or decades reflect broader economic trends, monetary policy regimes, and generational shifts in investor behavior. Successful navigation requires awareness of which timescale is most relevant for one's particular objectives and strategies. The evolution of trading technology has dramatically altered market dynamics over recent decades. Algorithmic trading systems now execute vast numbers of orders in fractions of a second, responding to market conditions faster than any human could perceive. High-frequency trading firms compete to shave microseconds off execution times, seeking to profit from minuscule price discrepancies that exist only momentarily. For traditional participants, this technological arms race creates a fundamentally different trading environment than existed in previous eras. The patterns of price movement, the nature of liquidity, and the characteristics of volatility have all been transformed by these technological changes in ways that continue to evolve. Market surveillance and the detection of manipulation present ongoing challenges for regulators and participants alike. Sophisticated manipulation schemes may involve coordinated actions across multiple instruments or markets, making them difficult to identify in real time. Spoofing, layering, and other manipulative practices can create false impressions of supply and demand, inducing other participants to make decisions based on misleading information. While regulatory authorities work to detect and punish such activities, the complexity of modern markets and the resources available to malicious actors mean that manipulation likely occurs with some regularity, particularly during periods of low liquidity when smaller amounts of capital can move prices more dramatically. The prudent approach for participants without access to institutional-grade resources and information involves several key principles. First, maintaining realistic assessments of one's informational and analytical disadvantages relative to sophisticated actors. Second, avoiding excessive leverage that creates vulnerability to unexpected market movements. Third, recognizing that market timing is extraordinarily difficult, even for professionals with vast resources. Fourth, understanding that volatility creates both opportunities and risks, and that the same forces that can generate quick profits can also produce devastating losses. Fifth, accepting that markets are not perfectly efficient or fair, and that structural advantages exist for certain classes of participants. The broader context for precious metals markets includes monetary policy considerations, geopolitical tensions, industrial demand patterns, and psychological factors that influence investor behavior. Central bank policies affect the opportunity cost of holding non-yielding assets like gold and silver. International conflicts and trade disputes can drive safe haven demand. Technological developments in electronics, solar energy, and other sectors influence industrial consumption of silver. All of these factors interact in complex ways that resist simple linear analysis. Ultimately, navigating commodity markets successfully requires humility about the limits of one's knowledge, discipline in risk management, and realistic assessment of the structural features that shape price formation. The markets are not designed to be fair in the sense of providing equal information and capabilities to all participants. They are competitive arenas where advantages accrue to those with superior resources, information, and analytical capabilities. Understanding this reality allows participants to make more informed decisions about whether, when, and how to engage with these markets, and to structure their activities in ways that acknowledge rather than ignore the structural challenges they face.